Hey everyone, welcome. I'm Cary Smith and I'm sitting here with Amar Shah. We're both with Client First Capital. And so, Amar, you and I have been talking a lot lately about the importance of having fixed income in a retirement portfolio. And so, together we've sat down and we've come up with the top 5 insights for having fixed income in your retirement portfolio. So, let's just go
Hey,
through
Cary,
that.
Cary, could you hold on a sec?
Yeah,
Could,
what's
could I borrow $100 from you?
Can you borrow $100? Is this in addition to the $100 that you borrowed from me last time that I'm not sure I got back?
Uh, are you trying to judge my credit worthiness? No, I will pay you back. I'll pay you back before the end of the year.
Okay. So could you pay me $5 a month until the $100 has been paid back?
Yeah, I think I can do that.
Okay. All right.
And so,
You
so we got
know,
a deal.
all right, we got a deal.
That is actually what a fixed income investment is, right?
Well, you know what it is, Amar. It's a fixed payment on a fixed time schedule.
Yeah. So I think that provides a lot of value in terms of just understanding for as an investor. Our first topic, which is stability and predictability, right? Like
That's right.
the interest payments that you're going to get. You also know when you're going to get your principal back. Usually, the principal you get back is 100% of the principal you put in, right? So you're typically getting all your money back. And then you know the risk that you don't get your money back is really the credit worthiness of the person that you're lending money to, or in the financial world, the institutions that you're lending money to.
Okay. Yeah, very good. So that was the first one, stability and predictability, which is important, I think, for retirees. So the second insight that we came up with is risk and yield trade-off.
Yeah. And so we just talked about credit risk, but the biggest other trade-off is interest rate risk. And interest rate risk is directly correlated to the yield curve, which we take the interest rates that short duration bonds are paying, intermediate duration bonds, and long-term bonds. And then we put a line connecting the dots of all three, and then you get the curve either is going up like this, is flat, or is inverted. And that kind of talks about the interest rate risk. One of the things that we're experiencing right now is that yields are starting to come down. We went through this raising interest rate cycle, up, and now we've had our first rate cut in a while, 50 basis points. And so that's changing the shape of the yield curve. Now, keep in mind, the Fed only controls the short end of the yield curve, and the public markets, um, control the rest of the yield curve. So it'll be interesting to see how it changes over time.
Yeah, it is interesting to see that. So the third insight is diversification with fixed income.
Yeah, boy, this one is it's a little bit harder because we probably have conflicting views on not you and I, but you and I in the industry. Because yes, fixed income can help diversify a retirement portfolio. However, I would say this is the biggest caveat is that during periods of market volatility, the correlations between the S&P 500 and TLT, long duration bonds, or the US aggregate bond index, the correlation of those two with when the VIX goes up, the correlation of those two asset classes gets closer to 1. And what that means is that when you need the diversification, it's not helping you, right?
Right.
So the big takeaway here is that if you look at the last 20 years of market data, and you see stocks and bonds in a normal market cycle, yes, it's helping diversify. But when risk goes up, bonds are not helping you protect the downside. They're not helping you diversify. And so when we look at this from our lens here at Client First Capital, our view is really to look at what has the highest risk adjusted return depending on the current environment that we're in, right? So we have a quadrant based approach, and we can see that in a deflationary state where growth is decreasing and inflation is decreasing, bonds really do well, right? And that's a good risk adjusted asset class to own. Whereas when inflation is going up and growth is going up, you don't want to have bonds. It's a drag on your overall performance.
Yeah, very good. Okay, so the fourth insight, if I'm keeping track of this right, the fourth insight is, and this is an important one, I think, to a lot of retirees, but it's generating income.
Yeah, generating income, but let's call that asset allocation, or let's call it asset location, not
Okay.
allocation, because I think the big part here is where are you generating that income, right? So keep in mind, a bond, the interest and dividends that you're receiving, if you own the bond outright, you're getting interest payment. If you're owning a bond mutual fund or an ETF, you're getting a bond dividend, right? But both are taxed at ordinary income rates. So if we own bonds in a taxable account, that's going to come up on our 1040 as ordinary income. If we own bonds in an IRA, 401k, even Roth IRA, you probably wouldn't want it in a Roth IRA, but all of these accounts, you do not get a taxable income from that bond. And so typically what we're looking to do is focus on asset location when it comes to fixed income. Most of the location of our bonds should be in our IRA, 401ks, 403bs, TSPs. You want the income component to be in your tax deferred accounts.
Okay, so location, not allocation.
Exactly.
All right, very good. And so, which actually is the next insight, which actually is asset allocation. So, all right, Amar. And so the fifth one on our list of five is tax efficiency.
Right. So the tax efficiency is really talking towards those individuals with high incomes that are potentially in a high income tax state, like California, right? Massachusetts, right? So in those states, the local municipality bonds, most of them can be triple tax free, meaning state income tax free, state and local tax free, federally tax free, and AMT preference item tax free, right? So it's like you get the benefit of investing in local communities, and the added benefit is that you're not paying taxes on that interest that you earn. Now, most municipal bonds are fairly safe, right? There's general obligation bonds, and then there's revenue-backed bonds. Most of these bonds, like school districts, water, sewage, like think of like your core essentials, they have less than a 1% default rate, like historically, since the start of fixed income. So usually this is a good way to get a safe investment in your local area, but also get the tax benefits that would make your after-tax return somewhat equivalent to a blended portfolio, right? So it's something that high income earners should definitely look at.
Yeah, very good.
I think, man, the last part was a tongue twister for me. But if you're still watching us, thank you for watching. Please hit the like and subscribe button. It helps the YouTube algorithm. It actually helps other people find us because the YouTube algorithm lets them know that we're creating content around retirement planning, investments, taxes, and estate planning. If you have any questions or concerns, you can visit our website, which is clientfirstcap.com. On there, we have a link to our newsletter, which is just one issue a month. And we have our phone number. So if you have any questions or concerns about your situation, you could reach out to us directly. Thank you for watching.
Yeah, thanks
Thanks,
everyone.
Cary.